Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points, which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
The algorithm knows you better than your friends and has lower expectations. Eating healthy is simple until taste gets involved. We need to talk has ended more peace than most conflicts. Your call is important to us is immediately followed by proof that it isn't. Discounts make people buy things they didn't need at prices they didn't plan.
Wall Street just had a very good quarter, and no, it's not because things are calm. The 6 biggest US banks pulled in a record $45 billion from trading, up 17% year on year. Turns out uncertainty is excellent for business, if you're on the right side of the trade. Rates affects commodities, everything's been moving, and banks have been happily taking a cut on every move. The more the market debates, the more they monetize the confusion. And the stocks, they followed the revenue, some doubling over the past year. Global inflation looks calmer until you read the fine print. Most developed markets are hovering in the 2 to 3% range, but many are ticking higher again. The US at 3.3%, Eurozone edging up, and even low inflation regions are losing momentum. Meanwhile, parts of the world never got the memo. Turkey at 31%, Argentina at 33%. That's not inflation, that's a lifestyle. So the narrative of inflation solved is slightly optimistic. What we are really seeing is fragmentation. Some economies stabilizing, others still firefighting. Manufacturing share in India has been drifting lower for over a decade now. And reversing that isn't just about intent, it's about execution. Yes, policy tailwinds are strong, PLI schemes, China Plus One, supply chain realignment. But history says that this shift moves slowly. The US might edge up from 10% to maybe 11 to 12% with reshoring. India, a move back towards 15 to 16% is plausible, but 17% needs sustained capex, logistics reform, and productivity gains, and not just incentives. Markets are already pricing the story. The real question is whether the plumbing catches up. Because manufacturing does not respond to announcements, it responds to efficiency. India's IP registrations just dropped nearly 60%, which sounds alarming until you realize last year was unusually strong. This looks less like collapse, but more like normalization after a surge. But the structure matters. Trademarks dominate, patents are still niche, and most activity is concentrated in a handful of states. So this means broad-based innovation is still a work in progress. The better signal, India is filing, but not yet scaling deep tech ownership at the same pace. Quantity is rising rather than quality. India's renewables are now 26.4% of power, and that's more than a green badge. It's macro armor. Every extra unit of solar and wind quietly chips away at oil and coal imports, easing pressure on the rupee and the current account. Solar is doing the heavy lifting, fast, scalable, and politically loud. Hydro steady but moody with the monsoon, while wind and biopower just keep showing up to work. It doesn't make India crisis-proof, but it does make shocks feel more like speed bumps than potholes. Here's the awkward part. India is getting FDI, but it's quietly leaving too. Gross inflows look decent, but net FDI is negative. Translation, more money is exiting rather than entering. At the same time, credit growth is sprinting ahead while deposits are catching their breath. So liquidity isn't exactly abundant. Add in hesitant portfolio flows and rising imports, and the rupee is basically fighting with one hand tied behind its back. It's not a crisis, but it is a steady drag, less cushion when the dollar flexes.